From New York City for our viewers worldwide, I'm Dani Burger. Your 4th of July holiday ends abruptly for Jobs Friday. The numbers send the markets for a ride, but we end up right back where we started before the release of the data. Is it holiday trading or was it already priced in? The countdown to the open starts right now. We begin with the big issue, jobs numbers climbing past estimates.
It's the revisions and a little bit the unemployment rate figure that the markets are most focused on here today. Look, I think this is supportive to the story of slowdown in the labor markets that Powell is looking for. I think you see that in the bond market reaction. And I think this keeps September on the table.
Joining us now is Michael McKee, Bloomberg Chief Economics and Policy Correspondent. Mike, you just look at the headline number and you get a sense of strength, that it comes in more than expected. What else is behind those numbers?
A lot's behind those numbers. The 206 that we got was higher than most analysts thought, but it is backed up by a decline of 111,000 jobs in the prior 2 months. So not good news overall in terms of the strength of the economy. Not terrible news, but it does show we're slowing down in the labor markets. We got the same signal from the unemployment rate, which rises to 4.1%, just barely 4.054 if you take it out to 3 digits, but it rounds up to 4.1. We got average hourly earnings and hours worked as forecast, a slight decline in earnings and no change in hours worked. If we were really falling into problem with the economy, you'd expect hours worked to go down. Now, last month we had a big question about whether the household survey was correct because it saw 408,000 jobs lost, while 272,000 was the initial print for the month of May. In this case, they're much closer together. We're seeing 117,000 jobs in the household survey, which is at least a positive number. It's not the 206, but much closer to it than we were the prior month, so we probably will not have an argument over that. Where were the jobs? Now, this is really interesting. Service industries, 117,000 jobs. Now, that is a fairly low number given the size of the service industry in the U.S. And look at that temporary help number, down 49,000 jobs. Is that telling us something? Healthcare and social assistance is the usual job provider for the economy and did again this month. But government, 70,000. Now, the question becomes, is there a seasonal adjustment factor there that's at work because of the end of school? That's going to be a question to be sorted out, because if it's just government workers getting hired, it's not going to be necessarily a sustainable good thing. So take a look overall with our ECAN function, which, as I say every week, is something that you can call Dani. She'll get it for you if you need it. If you don't have a Bloomberg, do this. And you can see where the jobs are and aren't. And the top blue on the far right is the government number. And that's the big contributor this month, along with education and health services. And you can see below the zero line, the purple kind of, I don't know, what do you call it, mauve or something like that? I'm not an expert on this, but that's the temporary help services, and they're losing jobs, and that's part of the problem. So you can break it all down on ECAN, and we invite you to do so, and then maybe give us your opinions, because this is one of those where we just don't know exactly what it's going to mean for the Fed, other than we're seeing more money go into the September contracts for Fed funds futures.
I feel the need to just make this clear, Mike. I cannot get anyone a Bloomberg terminal, nor can I give you a discount as much as people would want.
Well, I always tell people to call you late at night. That's the best time.
Well, I'm usually awake late at night getting ready for shows. Mike, thanks so much. Michael McKee breaking down the data for us. Joining us now is Rieder, BlackRock CIO of Global Fixed Income. Rick, thanks so much for joining us. Let me just get your first take on the jobs data.
So thanks for having me today. So the first thing I'd say is it's softer. I mean, the trend continues. The number that I focused on was the same thing that Mike McKee said, 49,000 negative in terms of temporary hiring. That's a pretty good indicator of some softness. By the way, it's the third straight month of negative, so it's not like it was coming back. Secondly, I think professional business services negative. So that's you're starting to see some softening. And then you break down, I think like Mike was saying, if you take 70,000 government, 82,000, that's healthcare and education, not cyclical, not interest rate sensitive. Then you look at the cyclical components, you're not seeing a lot of hiring. So the trend is real. And, I think we're slowing. The pressure on the labor market is definitely coming off. Consistent what we're seeing on claims, consistent what we're seeing, even though a little bit of a bounce in the job openings and jolts. But you look at ISM surveys. I mean, the economy's softening, but it's you're still 3-month moving average of jobs, 177,000. You're slow by I think it was 225 or something, 6-month moving average. So you're slowing. The trend is real, but boy, it's hard to get worked up to the economy. People, the ones that people like to talk about the hard landing. It doesn't. This doesn't tell you anything that economy's hard landing.
And maybe that is why, Rick, you see a bond market that had a reaction to push yields down, but we were basically back before where we were before the data announcement. Same thing with risk assets, same thing with equities. You get a slight reaction and then back to normal. Is it because this is a confusing data with lots of parts to wrap your head around? Or is it because we're all at the beach somewhere, except you and I today?
I think the latter. I think listen, I think, first of all, bond market has a pretty good rally in the last few days. So we're now pricing in fully 2 cuts. Hard to argue you should move a lot more than that. You've had a pretty good move in the 10-year note that, I think we've gotten to a place where you've priced a bunch in already. And, by the way, the same thing with the equity market. We've had a pretty good move. So, this is confirmatory of an economy softening, confirmatory of the fact that the Fed is going to go in September. I mean, I think the odds are quite high that the Fed's going to go 25 in September. Again, it's a lot to come from here to there, but I think you can get another 25 done in December. I think the key point, Andy, that when you go back to, if you think where we are today versus 6 months ago, core PCE running 2.7, real GDP we think is trending 1.5 to 2, employment slowing, the Fed funds rate of 5 and 3 is not the right number. Fed should start getting 25, 50, get 100 basis points ultimately off the Fed funds rate over the next year or so, and then see where you are.
But it is a Fed, Rick, that is talking about cuts with the bar of real deterioration, that when the labor market starts to show some real weakness, that's when they will move. I know that there are pockets of weakness in this report. When you look at revisions, when you look at an unemployment rate at 4.1%, but if it is a high bar, is something like today's numbers enough to confirm Fed cuts, or do you need to see something that looks like a bigger drop or a bigger move higher in unemployment?
So no, I mean, so I'll say one thing that's really important. We're not talking about a significant easing. All we're talking about is a Fed moving from what is overly restrictive on parts of the economy, meaning, if you look at the data, earnings reports, otherwise, credit card delinquencies, lower incomes having some real pressure, small business, real pressure, local banks, real pressure. You've got a Fed funds rate that's 5 and 3/8, too high. We need to get the funds rate. I mean, even if you got the funds rate to 4.5, not by the end of this year, but if you got it to 4.5 sometime in the middle of next year, you've got core PCE at 2.7. So this is not, gosh, we've got to ease to stimulate the economy. This is just get the funds rate from very restrictive to restrictive, and that is a clear endpoint that you can get to without feeling like, gosh, you're going to create any fuel to the fire.
And as you say, the bond market is priced in large part to that end of this mid-cycle adjustment rather than a classic easing cycle. So where can bonds go from here? Are we just forever stuck in this range if the Fed is on track to do that tweak instead of an actual large cutting cycle?
So, I mean, I've been doing fixed income for a really long time. I mean, one of the beauties of fixed income today is we're going to be in a higher rate environment for a period of time. Your ability to clip coupon and income, and we run a bunch of funds here clipping 6.5 to 7 real income and real yield. And that quite frankly, I'd love that to stay there for a while. My guess is you're probably going to take 50 to 100 basis points off that over the next 6 months to a year. And anyway, but that's the environment we're in, and which is pretty good. I mean, if you're in a world where you'd like to get some income, equities have had quite a good run. I mean, that's a pretty good place. I've called it the golden era of fixed income. I mean, not because rates are going to drop and we're going to be a significant bull market rally, but gosh, to create this sort of yield and have a sense that the central bank's not going to be raising rates anymore. By the way, not just the Fed, the ECB, the Bank of England, other than the Bank of Japan, we're in a global easing cycle. It's just a gradual one. Not bad if you want to create some income.
And it is that Goldilocks that's playing through markets. The tension, Rick, has been from politics. It's going to be a heavy weekend of seeing how Biden performs in an ABC interview with George Stephanopoulos, but it's allowed traders to start to look for Trump, to start to look for a curve steepening that was interrupted by the economic data. So how do you look at these two? Is it too early to start trading in some of the political ramifications for 2025, or will that continue to pressure some of the economic, the starting of slowing that is currently rippling through bond markets?
So this is a year that is, I saw a stat the other day that was pretty extraordinary. 80% of the market cap in the world is going to have an election in 2024. 60% of GDP is going to have an election in 2024. So elections are going to drive bond market, equity market. And you think about particularly U.S., you have a dynamic where you're talking about very different tax policy, very different fiscal policy potentially. By the way, you don't know what Congress is going to be. One man's opinion, it's a pretty good opportunity. You get extreme moves on one side when one party takes the lead or performs well or doesn't. And it's been a pretty good environment to take advantage of going the other way because we're still not in October yet, and we're on the doorstep of the election. And by the way, we've had a French election. We just had a UK election. You know, we're going to have there's emerging market election. I mean, there's a lot going on. I think it's an opportunity to take advantage of it. I don't think rates are going very far. I think equities will continue to grind higher. I think the dynamic around the technicals and fundamentals of equities are pretty darn good. But it's an environment where you get extreme moves on some of these election news, not just U.S., that it's a pretty good opportunity to take advantage and maybe go on the way because markets tend to overreact, particularly in quiet periods. They tend to overreact. And, to tactically fade some of that, particularly when you're in front of the election news, I think is a pretty good opportunity.
I was going to say, if you put that trade on with France, which I hope you did, Rick, you really would have paid out on that because you see spreads widen and then you see election results start to come in saying, okay, maybe Marine Le Pen's far right party isn't going to get the majority that they want, and spreads come in. They still are wider than they had been before the start of the French election, before Emmanuel Macron called the snap election. So do you want to keep buying French bonds, Rick? Does it normalize, or is that something you maybe don't want to step in front of at this moment?
So, I'll say a couple of things. Russ Brownback, my colleague, who's runs a lot of our global portfolio, has been amazing at this. I think you take advantage of it when it moves to extremes. But I think the better do you want to be in the epicenter of the volatility in France for a variety of reasons? Not sure. Tactically, maybe do a little bit, and we've done a little bit of that. But gosh, the other places like Ireland, Spain that come under pressure. And there shouldn't really be any contagion. We're not talking about the breakup of the Eurozone. We're talking about a dynamic around what is intra-France. And so to take advantage of the opportunities, both on the debt and the equity side, when you get sort of these extreme moves and people say, my gosh, there's contagion, currency contagion, et cetera, we think playing around the periphery, literally around the periphery of to take advantage of some of that is actually, we think from a convexity, from a risk-reward perspective, pretty good.
And all this just also brings us back around to the U.S., doesn't it, Rick? If you look at some other things that are happening around the world and the perceived safety of a U.S. Treasury bond in this very moment. But again, going back to what we were just talking about, as the political rhetoric ramps up, can U.S. contain those sorts of international flows that are worried about France, that are worried about elsewhere in this world and come back around to us? Can we continue to be that least clean, the most clean, dirty shirt?
So by the way, the first thing I will say is the reason why we have a dirty shirt or our dirty shirt is the debt in the U.S. is too big. And at some point over the next couple of years, that is going to be something that is going to manifest itself. So I would argue the U.S. is the most resilient, extraordinary economy in the world. It has the ability to take an incredible number of punches. And I always call it the flex economy because it has the ability to take so much pressure in terms of what happens around the world. There is one dynamic away from anything significant from the geopolitical side that I think we got to be careful about, and that is the size of the debt burden. And that is something we're going to watch over the coming years. It doesn't seem like anybody's running for election with the idea, let's get the debt down in the United States. So that is something that is definitely on our radar screen. Away from that, gosh, you can throw a lot at the U.S. And because of technology, energy independence, healthcare development, the U.S. is pretty darn impressive in terms of its ability to withstand stress.
Rick, we're going to have to leave it there. Thank you so much for joining us, for cutting your holiday short. Rick Rieder of BlackRock there. Okay, let's get a look at some of the stocks that are moving ahead of the opening bell. With that is Jess Menton. Hey, Jess.
Well, Dani, happy Friday here on this holiday shortened weekend. You do have stock futures kind of bouncing around the flat run here, even after that jobs report coming off those session highs, but the S&P 500 and the NASDAQ 100 still higher for the week. But if you want to look at some individual movers here in pre-market trading, not surprisingly, you are seeing crypto-linked stocks moving lower. That is because Bitcoin falling for a fourth consecutive session. You're seeing it trading around 55,300 roughly here. So it's actually at the lowest that it's been trading at since February. And it's also lost roughly a quarter of its value since it hit that record back in March. Obviously, some of the hype coming off of the spot Bitcoin ETFs. Also still regulatory challenges here. Some individual movers, though, you want to see Marathon Digital down almost 7% pre-market trading. You're looking at Riot Platforms down about 5%. And then, of course, Coinbase down about actually more than 5% right now, Dani.
Okay, Jess, thank you very much. Coming up, we're going to go to the White House to get the reaction from this morning's jobs number. 190,000 was the estimate. We're at 206. Julie Su, acting U.S. Labor Secretary, will join us from Washington next. This is Bloomberg. Less than an hour ago, we got U.S. jobs data coming in at 206,000. The unemployment rate goes from 4% to 4.1%, with a big revision for the months prior. For the Biden administration's take on the U.S. jobs report, we are joined now by acting U.S. Labor Secretary Julie Su. Julie, let me just get your first take on these numbers.
It's another very solid jobs report. 206,000 jobs created, bringing the total since President Biden came into office to nearly 16 million. I've been here before talking about the unemployment rate. We had an unemployment rate at or below 4% for the longest stretch since Neil Armstrong stepped foot on the moon. And it's ticked up slightly now, partly because we also see an increase in labor force participation rate among prime age workers. People coming into the labor market looking for jobs. It's taking them a little bit longer to find them, but we're seeing a balance between supply and demand when it comes to workers looking for jobs and employers finding what they need. All signs of a strong, steady economy.
The obvious flaw in some of these numbers, Secretary Su, might be the fact that we've had big revisions for the months prior, 111,000. When you look at some of the months prior, do you look at today's data and say, you know, we might expect another revision, that perhaps some of the rosiness of it seems to kind of be undermined with each next month of data that comes in and some of the revisions that come in?
I'm so glad you asked that question, because revisions are part of the numbers that come out. They've always been part of the numbers. It's why we're able to put out numbers every single month and then adjust them to make sure that data that comes in later is incorporated into it. That's why we don't just look at 1 month's data. That's why we look at trends. If you look at by any measure, since 2021, when the president came into office, if you look at the last 3 months trend, no matter how you slice it, the pie is getting bigger. There are more jobs in the economy, more workers are getting these jobs, and the real wages are up, so that means that more working people are also having breathing room to be able to live. Those are all not accidents. Those are all very much fundamental to President Biden's vision of how you build a strong America.
But it is an unemployment rate that did move higher, Julie, 4.1%. And this is what a lot of people have pointed to, that rarely does the labor market move in a linear fashion. The concern is if unemployment is moving higher, then a nonlinear move could be what's next on the cards. What gives you the confidence that that strength will continue and you won't see a precipitous move that goes from slightly soft to something more pernicious?
I mean, I guess I'll answer it this way. 4.1% still remains a very, very low unemployment rate. Our economic recovery under President Biden has been the most robust anywhere in the world. And so that 4.1%, it is slightly up from before, but looking at all historic measures, especially looking at recoveries from past economic crises, it is absolutely historic in nature, and that did not happen by accident, right? It was not inevitable. Most people bet against it. But President Biden said if we invest big in America, we can pull ourselves out of the pandemic, prevent economic scarring. And those investments, one reason I'm confident is that those investments are just getting started. The president's Investing in America agenda is putting more money into communities for roads, bridges, clean drinking water, for high-speed, reliable internet. We are tackling our climate crisis. We're putting more wages into workers' pockets. Just this past week, 1 million more workers became eligible for overtime pay because of this president's economic policies. Just this past week, we put in place the first nationwide proposed standard to protect workers from the hazards of heat. All of these are forward-going policies that make me confident that building an economy in which no one gets left behind and workers do well is not only possible, it's the only option for this president.
Julie, I think for this market, there's a lot of uncertainties about 2025. I know there's a lot of drama happening in D.C. this weekend with Team Biden and what happens with that and the election itself. It's always periods of uncertainty. I'm not going to ask you about that directly because I know that you don't want to talk about it. But when you think about this labor market and what we call the fog of 2025, how do you deal with that and think about that with still the outcomes unknown? And again, as you say, policy still needing to work out. How do you think about that policy when, again, we don't know what 2025 looks like?
No, we don't know. You're right. But I'm happy to talk about it because if we want to talk about the fog, the real fog is let's look back at 2020. In July, this day in 2020, the unemployment rate was almost 12%. For July 4th, Americans were told to stay home, stay away from people, because we had a pandemic that was out of control with no national strategy to address it. This president has turned that all around. We've been talking month after month about, is the jobs number too high? What is it too hot? Is it going to cool? And each time the answer is that we are moving to a stable, steady economic growth economy, and that is exactly what the president said could be done with the right vision, with the right economic strategy, and the right delivery. So there's no drama here on this side. We know that what we have put in place is working, and we just know that we have to keep at it.
And Julie, I know you've discussed this idea before that, yes, there is strength. However, it is not necessarily an American populace that sees that strength. A lot of these sentiment surveys that we see tend to show a weakening, and they've showed a real substantial weakening in the more recent ones we've got. Some of the explanations have been because of political uncertainty that we were just discussing, of not knowing what things look like. So does the messaging need to change, especially at this very crucial moment where Biden's survival is put into question for this election? Is the current messaging working, you think, on this labor market and the strength of the economy?
I mean, I can say what I see, right? One is, again, I come here to talk about the jobs numbers, and I'm very proud to say, again, none of these numbers, none of these outcomes were inevitable. They required solid leadership and strong economic strategy. We've seen past recoveries. They were not like this, right? The jobs that have been created under this president are more than have been created under any president in the same time period in history. When you look at what he and we inherited, that is it's really incredible. But I also think this is why I travel the country, right? This is why I've launched Good Job Summer, where I'm going across the country to talk about the need for good jobs in every single community. And what I see there is workers who want to work, Americans with tremendous talent that they want to put to use, and training programs, community college connections, investments that are creating those good jobs. We see them in the jobs numbers, but I see them when I travel and what the real impact is. And I think we see those sentiment surveys starting to turn too. But when I talk to American workers and America's families, they see a president who cares about them, who sees them, who knows that they're not invisible, and is willing to do the hard work to make life better for them.
Secretary Su, we really appreciate your time this morning. Hopefully you can enjoy a little bit of the July 4th festivities. Acting U.S. Labor Secretary Julie Su there. Okay, let's get you some of your morning calls now. A look at some of the analyst recommendations on Wall Street this morning. First up, Citi downgrading Charter Communications to a sell. The analyst says the company is facing risk to its valuation thanks to a tougher broadband environment. Next, Raymond James downgrading Spirit Airlines to underperform. Analysts citing a lower fuel outlook and weaker fare trends. Finally, China Renaissance is upgrading Tesla to a buy. The analyst citing the EV maker's expansion of its energy storage business Business and new products from its full self-driving initiatives and robo-taxi units. If you're just joining us, we got payrolls about an hour ago. 206,000 is where it landed, revised down for the prior months by 11 and 10,000. S&P 500 futures little changed. Coming up, we'll talk about just that with Nancy Tengler, CEO and CIO of Laffer Tengler Investments, how she's investing in the generative AI surge. You're watching the Countdown to the Open. I'm Dani Burger. Moments away, seconds until the start of trading. So we're about to get the opening bell. In the meantime, little changed on this equity market. An interesting reaction to jobs. At first, you get a move higher in equity, saying it looks softer. Maybe bad news is good news. We've started to unwind some of that. So little change for S&P. NASDAQ ever so slightly higher. This is the interesting one. Russell 2000 futures goes down nearly 0.4%. Perhaps this was all priced in. That's what Rieder was talking about earlier with us, saying that we already knew that the Fed was likely to cut 2 times. So this only just solidifies this. It doesn't make a big enough difference. Anyway, this is your equity market. Let's see what the cross-asset picture looks like this morning. Your euro versus the dollar, some strength in the euro. Perhaps that has more to do with stability in Europe. A UK election goes as expected. France, it looks like the far-right party is going to get a smaller majority than initially thought. Your U.S. 10-year yield, again, this thing is on a round trip. We're down 6 basis points before the jobs report, down about 4 basis points. Only a slight change. Again, was this just confirming what we already knew? And meanwhile, your NYMEX crude, that is at $83.82 a barrel. Let's take a look under the hood and get some of the stocks that are moving at the start of trading this morning. Joining us now is Bloomberg's Jess Menon. And Jess, I mean, a huge drop in crypto. I know that's one of the ones you're looking at this morning.
Of course. So I have to point out what's happening with Bitcoin because it is on pace for its 4th consecutive session of declines here. So if you look over at this, at where it is currently trading around 55,400 roughly there. That's the lowest level since February. Also lost about a quarter of its value since obviously hitting those highs back in March as some of the sort of hype around the Bitcoin spot ETFs and obviously those regulatory hurdles go underway. But a lot of those, if you're looking at some of the individual stocks here, Marathon Digital here down almost 6% now right after the opening bell. Riot Platforms also down close to about 5%. And then you also have Coinbase, of course, down roughly about 6% too.
And Macy's, I know, also on your mind this morning, the will they, won't they of someone finally buying Macy's. Where do we stand now and what's the stock action?
Right. So right now you have the Wall Street Journal actually put out their reporting here. So you have 2 different actually, when you're looking at this, investment groups that are trying to sweeten this type of offer to increase their stake to take Macy's private here. So when you are looking at Macy's stock, actually up about 8% right now, and it's also moving other individual department stores higher too. If you want to look at Kohl's, up about 0.2%, and Nordstrom's also up about 0.4% here. If you look at Macy's, you want to get some size and scope on today's move. Actually, it's best since March 4th earlier this year when it had jumped close to about 14% here. But of course, when you think about sort of the competitiveness when it comes to the retail landscape, Dani, and especially when you think about Amazon and the issues big box retailers as well as department stores have gone through well over a decade now, this is something that's been ongoing. But Macy's stock even coming in today was already down about 11%. And we know retailers, especially their margins getting squeezed, especially coming out of the pandemic, that's been a big issue there. But nonetheless, you are seeing some of those department stores moving a bit higher this morning.
And Tesla, we should say, erasing its year-to-date losses.
That's right. So don't sleep on what's happening with Tesla's stock. So to put this in context, if you looked at the first half of the year, Tesla was down about 20% going through the end of June. Now, when you're coming out through the winning streak that it has been on, it's actually just turned positive for the year. Its week-to-date gains is actually roughly around 25%. Of course, we know Dan Ives over at Wedbush, a well-known stock bull who did raise his target on a 12-month basis for this stock earlier this week from, it had previously been 275. It's about 300 now. So that would basically imply around a 20% rise actually from Wednesday's close, since yesterday was obviously a holiday. If you look at the A&R function, though, for Tesla, 27 buys, 20 holds, and 13 sells right now. But still, that is another stock that obviously was vastly underperforming the broader S&P 500 because of those growth concerns, and now rebounding pretty sharply coming into this new quarter, Dan.
Yeah, although some of those gains are running out. I'm looking at the year-to-date gains, and it went from erasing them to down 1% for the year. Just thanks Thanks so much, Jess Menton there. Joining us now is Nancy Tengler, CEO and CIO of Laffer Tengler Investments. Nancy, of course, you and I are going to talk about NVIDIA and tech, but we have to talk about what's been on the docket so far, and it is the jobs data. Sure, the headline comes in higher, but it is an unemployed rate that goes to 4.1%. I just want you to help me make sense of some of this equity market move. You have a stock market that's basically unchanged and small caps that are down 0.5%. I just want to get your take on that.
Yeah, well, I think for me, and Dani, thanks so much for having me. I think for me, the issue has always been the revisions, and they continue to come in pretty hot. And so the market, I think rightly, is not necessarily paying attention to every dot and twiddle like we do, but rather is sort of looking at trend lines. And what we see is that the labor market is softening, and we've been talking about that for 6 months. You could see it in the number of full-time jobs, which declined 275,000 in March, year over year. You can see it in average hourly earnings rolling over. And so while the equity market isn't necessarily responding to it, I think we've already started to price in a cut in September and potentially one more before the end of the year. And I can't make any sense of small caps. They rallied heavy last year, and we've been out of them. Like, we have not been one that said in the fall, jump in. We looked dumb for a couple of months, and then they've just done nothing but sell off. And I think part of that is this whole story that the big keep getting bigger and are benefiting actually from higher interest rates, and will also benefit from declining interest rates.
See, this is the thing, Nancy, is you could say, oh, I knew what jobs would come in and I knew all the data, whatever, and you probably still wouldn't have been able to tell me how this market reacted, because it is a confusing one, especially if big cap tech will do well, to your point, in both higher and lower rates, because the philosophy had been higher rates means you have to discount future cash flow and it won't be good. And we've learned the lesson that that's not necessarily true when these giants have big cash stockpiles. So do I just buy tech? Is there anything else I can invest in if the direction of rates is known, but the volatility of it isn't necessarily known?
Well, I mean, there are other things to buy, but let's also remember that the hedgies are all in the Hamptons. So we've got, reduced volume. We've got, a lot of people not paying attention today. And so the market may just sort of drift around until the close, when it may, in fact, rally. But our theme has been old economy companies. We've talked about this. That are focused, that have pivoted to digitization first and foremost, and then it became cloud computing, generative AI, cloud computing. And so there are a lot of names in our portfolio that have actually exceeded the performance of the S&P that are not in technology. So think Goldman Sachs and American Express, think Quanta Services, Raytheon Technologies. These are all companies, Chipotle, that have, embraced digitization and or automation, robotics, and that has benefited their overall performance. Walmart, Tesla, those are names that we talked about in April. Around earnings, and you reported on Tesla. That's been a great holding, at least for the last 3 months.
Nancy, thank you for reminding us that there are other stocks out there besides NVIDIA. I'm going to be honest, sometimes I forget when I wake up in the morning and check what NVIDIA is doing. I found it really interesting, too, that Piper Sandler on Wednesday dropped their coverage of the S&P 500, saying that they were no longer going to give price targets because it's no longer instructive for their investors. They called it an exercise in futility to call the S&P 500 the market, because at this point it sometimes feels like it doesn't properly reflect what's happening under the surface. I just want to get your take on that. I mean, every day when we're talking about the S&P 500, if it continues what it's doing now, going to be another 34th record high for this market. Are we missing the point by just talking about the headline index at this moment?
Well, I mean, yeah, it's just like talking about the Dow to some extent. That's sort of an old memory for many of us that started in the business in the 80s. But I also think dropping coverage could be a little bit about job security, because we've seen a couple of strategists who've been wrong, who've been epically wrong. And that's the risk when you're trying to, estimate. I mean, I wish the Fed would do a little bit more estimating and looking forward, but you do have to take a look at a whole host of things just besides price targets. And if you look at the concentration in the S&P, look at it compared to other developed markets. We're much less concentrated than the DAX and the CAC and the FTSE. But also, negative breadth is characteristic of a bull market environment. And I've drawn the analogy to the 90s for the last year when I was actually managing money. This is also what we saw then. We saw periods of very concentrated movement, and stocks continued to do just fine for a long time. So I think everyone should take a breath on some of this and look, as we have, to other aspects and other sectors of the economy.
Nancy, you are one of the best. We love having you on. Nancy Tengler of Laffer Tengler Investments. Thanks so much. And by the way, Nancy obviously couldn't name names, but I will go ahead and do it. Marko Kolanovic leaving JP Morgan. We learned that in the middle of the week. Not necessarily saying it was because of this, but he has had a string of wrong market calls. Okay, coming up on the show, a Labour victory.
From now on, you have a government unburdened by doctrine, guided only by the determination to serve your interest, to defy, quietly, those who have written our country off.
We're going to discuss election risks around the world up next on Bloomberg.
From now on, you have a government unburdened by doctrine, guided only by the determination to serve your interest, to defy, quietly, those who have written our country off.
I am sorry. I have given this job my all, but you have sent a clear signal that the government of the United Kingdom must change, and yours is the only judgment that matters. I have heard your anger, your disappointment, and I take responsibility for this loss.
The Labour Party winning a landslide victory in the UK election, dramatically reshaping the political landscape. Let's get over to London, where Bloomberg's Anna Edwards is standing by. Anna, what sort of mandate does Labour now have to lead after this election?
Hi, Dani. Yes, well, on paper, a very big mandate. You know, as you say, a landslide victory for the Labour Party, not quite as good as Tony Blair in 1997, but not a million miles away. And so that does give a big mandate, and that with that comes a lot of responsibility, as we heard Keir Starmer saying, echoing Tony Blair a little bit earlier on this morning. There are some cracks in that, though, in that because of the way that the UK system works, they secured this even on quite low turnout. Their vote share didn't really increase all that much from 2019. So they didn't necessarily win all the arguments, but certainly their rivals were struggling. The Conservative Party, certainly the SNP in Scotland, all of them struggling. And that's the way the UK system works. As a result, they get this big landslide, and now they have, as you say, their hands on the levers of power. And so 14 years of Conservative Party rule is brought to an end. All of the chaos and turmoil that went along with that. And we remember, of course, the Brexit referendum in 2016. That was a big distraction for everything UK political for a very long time. And then into the pandemic and the inflation push that we saw, and that was very much a global story as well as a UK one. But that led to a lot of infighting within the Conservative Party. And so now we turn the page to something else. Keir Starmer trying to sell a message of hope, trying to sell a message of thinking about the future today. You heard a few of his words there. He's trying to say, you've lost trust. We're trying to build belief in the future. That hard work starts today. He wants to be a government of stability and moderation. And Dani, he talked about public service time and time again on the campaign trail, and he was doing it again today. A real sense that the tone of UK politics will change. He'll get a chance to demonstrate that in the weeks ahead. He'll be at that NATO gathering stateside in less than a week, in fact, and then he'll be meeting with EU leaders later on this month, a chance to reset the UK's relationship on the global stage, at least from a tone perspective for now. Dani.
Anna, appreciate it. I know it's been a busy week for you, so go enjoy your weekend. Anna Edwards in London. Now, in the meantime, France is now getting ready to head to the polls this weekend. No rest there. The director of Institut Montaigne had this to say on what lies ahead.
As you know, it is absolutely critical that this budget law is passed for the continuum of state. So the main trial will be in the fall. That will be the moment of truth of the new government, whichever it is.
Let's get more context on the French election with Bloomberg's Caroline Connan, who joins us now from the Aix-en-Provence Economic Conference. Caroline, what is the mood among executives there? It is a market that has calmed down. Is there more confidence among those on the ground?
Dani, I've been covering this conference in Aix-en-Provence for more than a decade, and I can tell you it's a very, very different mood than usual. Usually it's the beginning of summer, you hear the cicadas, everybody is in a positive attitude, but with these snap elections, with this runoff on Sunday, there is a lot of anxiety among the executives here in Aix-en-Provence. And for the first time in more than a decade, there is absolutely no politician here. None of the ministers from Macron's government have made it here because most of them will actually lose their job in just a couple of days from now. So there is no need to despair, according to the Institut Montaigne director that we heard earlier, but there is not much sign for optimism either, because the two scenarios that we have at the moment, which is either an outright majority for the far right or a hung parliament scenario, are a little stressful still for the markets, a little stressful still for the executives, because that adds a lot of uncertainty for the tourism sector, the construction sector, the energy sector. I was talking, for example, to the Neoen CEO, specialist of renewables, just a few minutes ago. He was telling me there is a lot of wait-and-see attitude because we don't exactly know whether that means a less focus on climate change and perhaps less money for the transition, for the climate transition, less money for renewables. I was also talking to the head of a consulting firm called SIA Partners, who's based in New York now, and he was telling me the view from abroad. Remember, a month ago or 2 months ago, we were at this Choose France summit where Macron was inviting 100 CEOs to tell them about the greatness of France, the attractiveness of France. And now everyone is asking, why France? Why would we come to France? Why would we come to invest in France, given we're going to have this uncertainty for another few weeks? So a lot of anxiety, wait-and-see attitude, even though some of the polls are showing that an outright majority for the far right is not unlikely.
Caroline, appreciate it. Caroline Connan in France there. Now to do a trip around the world, let's head back to the U.S., where President Biden is headed into a make-or-break weekend for his campaign. He'll be sitting down for a primetime interview with ABC News as calls for him to drop out persist. Joining us now is Bloomberg's Joe Mathieu in Washington. Joe, not only are we going to have this airing tonight, but we're also going to get an unedited version, a transcript of how the interview goes down. So what is the Biden team hoping to accomplish? Is this enough to restore some of the confidence that was lost after the debate?
Not likely. I mean, even Democrats say we're going to need more than a single interview, Dani, but this is the start here, and it's going to be an important one. It's unclear how much time Joe Biden will give in this interview, and I think there's a hope that it's more than 10 or 15 minutes to see him walk through the paces here. But this is just the beginning of what's going to be a test that could last the better part of a week here, the way his schedule is looking. He's on to Wisconsin today for a rally that will likely include a teleprompter. Be going to Philadelphia over the weekend, and we've got our NATO summit here next week in Washington. That's a big deal. He's going to be hosting a solo news conference with reporters that could last an extended period of time at the end of the summit, and that could be an even bigger test than this interview today. But I'll point you to something else next week, and that's the return of House lawmakers here in Washington, D.C. And they've all been asked about this in various media interviews. They've been on the phone together, and we now have a third lawmaker. I just want to point you to the evolution that we're seeing here with some Democrats. Congressman Seth Moulton, a Democrat from Massachusetts, has now become the third House Democrat to call for Joe Biden to step down. He said so in a radio interview on the 4th of July in Boston, saying that the president should follow in one of our founding father, this is a quote, George Washington's footsteps, and step aside and let new leaders rise up, and run against Donald Trump. That's a quote. We talked to Seth Moulton on Tuesday here on Bloomberg TV. This is what he said to us when I asked him directly if Joe Biden should step down.
There's certainly a view that the chaos that would follow would be worse than just having a nominee that we know and that can trust. And then, of course, there's the other view that the debate was a disaster, and we just need to move on. I'm not sure exactly what the right answer is yet here, but I can tell you we are having those serious conversations as any serious party should.
Fast forward 2 days, those serious conversations lead Seth Moulton, a Biden ally, to call for him to step down. So that's what we're hearing, and conversations like the one that the president will have today in this interview are going to go a long way to lawmakers deciding how they feel about this in the week ahead.
It's interesting, this strategy, as you say, Joe, that this is just the first step, but get Biden out there, have him do M&As, have him talk to people in order to really get that confidence, again, that this is not a cognitive decline, that it is a one-off. But in the meantime, Joe, what's the horse trading happening in the background? If we are starting to think about someone else besides Biden, is that conversation still alive and well?
Well, it's a really important question, and I'm not sure anyone has a real answer, because these are quiet conversations being had. And I'll tell you, they, in the last couple of days, have pointed us back to Kamala Harris. You know, even the night of the debate, we were hearing about Gretchen Whitmer and Gavin Newsom and starting from scratch here. But there's a vice president. And when you look at some of the polling data, Siena and the Wall Street Journal both showed Joe Biden down by 6 points against Donald Trump. A CNN poll just out found Harris in a statistical tie with Donald Trump, and in fact stronger than Joe Biden when it comes to two important groups, women and independents. Kamala Harris has seen her favorabilities rise in our own Bloomberg swing state polling since she's taken on the mantle of a spokesperson, the face of the issue of abortion. So imagine a world in which Kamala Harris is tied up with, say, a popular Democratic governor, a Roy Cooper, maybe Governor Shapiro. There are a lot of different ideas about this right now, and could have a very interesting story to tell for Democrats, as opposed to throwing all of these pieces up in the air and starting from scratch in some sort of mini primary. A contested convention in Chicago in August could be very disruptive for Democrats, as Donald Trump learns now again his sentencing has been delayed, and he's going to soon be naming a vice president, making a lot of news in Milwaukee just a week away.
Yes, let us not forget that, Joe. A busy month, a couple months ahead on the road to November 5th. Bloomberg Balance of Power co-anchor Joe Mathieu there. Now, coming up, the market-moving events that you need to be watching as we wrap up the week. That's next in our Trading Diary on Bloomberg. Time now for your Trading Diary, what you need to be watching today and next week. President Biden will be giving an interview on ABC tonight. Powell is set to testify on Capitol Hill Tuesday and Wednesday. And then on Thursday, we're going to get CPI data. And Friday, big bank earnings kickoff. JP Morgan, Wells Fargo, and Citi start the earnings season. In the meantime, it is still a reaction to jobs data. Or is it? Are we all just at the beach and thin liquidity and these moves you can't trust? We did have jobs data. Headline comes in higher, but so does unemployment. So does revisions for the month prior. Russell 2000 down 0.5%. Your NASDAQ up 0.5%. It is still a tech-led market. Meanwhile, the S&P 500, 5,544 is where we trade up 0.1%. This was the countdown to the open. And beginning on Monday, tune in to Bloomberg Open Interest. That'll take place from 9 to 11 a.m. Eastern.